Your Money, Your Call. I'm Chris Weston. Roger, so we're going to talk about the markets to start with.
Sure.
Yeah. So we obviously had the big rally up from the lows today.
Yeah.
You know, what did you think of the market performance today?
Well, look, I have to tell you, I don't tend to look at markets on a short-term basis at all. So my I guess tendency is to focus on long-term opportunities. And despite all of the ructions that we've seen in the market over the last couple of weeks, the reality is the market seems overall on a fundamental basis and on a business performance basis to be a little bit expensive. So yes, the market's rallied a little bit from the lows. It's also come down quite a bit from the highs for many stocks. For me, that's not as important as where the price is overall relative to the value, and the price at the moment still is a little bit expensive.
We're going to take our first caller. We've got Anno. This is from Kangaroo Point. Anno, what's your question for the panel tonight?
Oh, g'day guys. Thanks for taking my call. Just a quick question about one of the worst performers on the market today, Ausenco. Particularly interested to get Roger's opinion as to whether he thinks this is a good business or not, and secondly, whether this drop presents a good, opportunity to buy this stock.
Anno, I can tell you it's got some interesting characteristics. The first one is it's got a very strong balance sheet, or a reasonable balance sheet. So the probability of the company defaulting or defaulting on its obligations is fairly slim. But in terms of the probability of its performance, it's mixed. I grade companies from 1 all the way down to 5 in terms of performance, and it gets a 4 for performance. Historically, its intrinsic value has only increased by about 6%, and look, it's forecast to increase a little bit more than that over the next few years. But in reality, it's expensive compared to its intrinsic value. In fact, I've got an intrinsic value at the moment of $2.77, and of course the share price is a bit higher than that. So my thought is that this is a business that is a mediocre business, a little bit better than mediocre, but it's trading at a premium to its intrinsic value, and the intrinsic value is not going to be rising by very much over the next couple of years.
I think you've also got to look at the fact they've come out with down 18% today. They've come out and said that they're going to make a first half net loss of first half 2010 net loss of 9 to 13 million. So
well,
certainly
back to my original point. It's the predictability of performance is difficult. That's why it scores a 4 compared to a 1, or a 2 even, and that unpredictability in its economic performance is why it gets a lower score there.
Yeah. How are you valuing the market at the moment?
Look, it's a great question. In actual fact, the answer is yes. So what I do is I'm looking at individual companies, and what I do is try and come up with a valuation for all of them, aggregate the ones that are in the ASX 200, aggregate the ones in the ASX 100, for example, and then from that information, come up with a valuation for the index. So when I said to you earlier, I thought the index was a little bit expensive compared to its intrinsic value. That's what I meant. It doesn't mean, though, that I think the stock market's going to decline. Valuing a business is very different to predicting where the share price is going to go. I can't tell you where the share price is going to go at all, so I'm not trying to predict that. But if the market is at a big discount to its intrinsic value on an aggregate basis, then I would say there's lots of value, and the opportunity is there to buy pretty much any good business, and you're going to do reasonably well. That opportunity isn't there at the moment. In fact, out of 400 odd 1,900 companies that I've got here, and you can have a look at all of those. The reality is that there's only the very high quality businesses that are trading at a discount. There's 4 of them. 4 companies that I think are good businesses and cheap out of 1,900 that I follow.
We're going to go to another question now. We've got Ted on the line. Hi Ted, how's it going, and what's your question for the panel tonight?
I have a general question about the banks. I've noticed that the ANZ, NAB and Westpac are all within a $2 range, which is about the most narrow band that I've seen them since I've been looking at the stock market. I know that Roger thinks that the Commonwealth Bank's the best business and that they're all overvalued, but I was just wondering if he could give his current values just to give me an idea of how overvalued they are, and I'd be interested in Tolly's comments as well.
Wonderful. Well, we'll start with you then, Roger.
Okay. In terms of the Commonwealth Bank, so if you look at the Commonwealth Bank, I've got a valuation of the Commonwealth Bank of $47.36 at the moment. And the price is obviously a little bit higher than that, just over $50. So it's close to its intrinsic value. It was expensive there for a while, but that intrinsic value rises substantially over the next couple of years. I've got it rising to $56 next year, and then $64 the year after that. So substantial increase in intrinsic value. The last time it was actually cheap was back in July 2009, and prior to that, obviously, in the depths of the financial crisis in January, February 2009. So it's been very strong up until April this year, and it's pulled back a little bit since then. So that's the Commonwealth Bank. If I go to Westpac, bear with me. So if I look at Westpac at the moment, interesting, Westpac's actually trading at a slight discount to its intrinsic value now. So we've got it trading at around that $22 mark. You can see there on the chart on the screens. But its value is closer to $24 at the moment. And again, its value is rising over the next couple of years. $26.36 2011 and $29.35 in 2012. So we've got all of the banks are pretty much the same story. You know, their values are increasing over the next couple of years. I might finish off, and I'll let Tully have a word in a sec, but I'll just finish off with the National Australia Bank. NAB, its value trading, where have we got it? Has it come up on the screen? There it is. Around $24 in terms of price, but its value is $22. So it's a little bit expensive at the moment. Its value, however, $28 next year, $28.32, and then $33 in 2012. So at the moment, the banks don't look particularly, they don't look massively overpriced. There's no bargains there at the moment. There's nothing trading at sort of 20-30% discounts to intrinsic value. But provided there are no left field events for the Australian economy, and that's a big if, provided that doesn't happen, nothing adverse happens to the Australian economy, then I suspect that these are going to be quite nice returns.
I just want to sort of jump in before we get the technical view. NAB's, I'm not sure how closely you follow price earnings on these companies. I think obviously NAB's underperformed because of the perceived capital raising if it takes out AXA. Obviously the markets are still a little bit hesitant about its UK operations and how they're going to perform. So it is trading on a discount on price earnings to the other banks, price to book as well. I mean, do you take that into consideration at all?
No, I have to raise my hand and say I don't look at PE ratios at all. I wouldn't know what the PE ratios are. I could look it up, but I wouldn't know what they are off the top of my head. Yeah. And in actual fact, I don't look at PE ratios because I think sometimes they can mislead investors into thinking things are cheap. What tends to happen is analysts have found that PE ratios don't work, so then they start using different types of PE ratios, for example, forward PEs or relative PEs. I was on this very program and I had another analyst sitting next to me, and I remember JB Hi-Fi was around $14, and he said that it had the highest relative PE ratio of all the retailers, and therefore it was expensive. And my view was, well, I actually think it's worth about $21. And that was a long time ago when it was $14. It's been up to 23. So there's a potential to be misled by PE ratios. So therefore I don't focus on them at all.